There is a company that touches $14 trillion. That is more than the yearly economic output of Japan and Germany combined. It is the largest shareholder in most of the biggest companies in America. Its software quietly watches over $21 trillion of the world's wealth, including money managed by its own competitors. And if you have retirement savings in a fund, there is a good chance some of your money is inside it right now. Yet most people cannot explain what this company actually does. And 14 trillion is a number the human brain simply refuses to process. So try this. If you earned $1 every single second, day and night, you would need more than 400,000 years to collect it. That is longer than modern humans have existed. One company touches that much money. This is the real story of BlackRock. And yes, at the end, we will deal with the conspiracy theories, what is flat out false, and what is uncomfortably close to true. The story begins with a catastrophe. In the 1980s, Larry Fink was a star bond trader at First Boston. The youngest managing director in the firm's history, promoted at 28. His desk pioneered the mortgage bond market, and in one quarter it made the firm $135 million. Fink looked untouchable. Then, in 1986, interest rates moved the wrong way. His hedges failed. In a single quarter, his desk lost $100 million. The golden boy became an outcast almost overnight. But that humiliation planted an idea. Fink realized that nobody on Wall Street, including himself, had truly understood the risks they were carrying. Everyone knew how to chase returns. Almost nobody could measure danger. In 1988, Fink and 7 partners started a new firm in a single room in Manhattan. 0 assets. One obsession, risk. And Fink did something unusual. He turned his own disaster into the sales pitch. He would walk into pension committees and tell them, in effect, I lost $100 million because we could not measure risk. I have built the machine that makes sure you never repeat my mistake. The failure became the product. Know exactly what you own and know exactly what could hurt you. The firm began life under the wing of the private equity house Blackstone, and when it later went independent, it kept a respectful echo of that origin in its name, BlackRock. In 1994, it split off completely. In 1999, it listed on the New York Stock Exchange. From a single room to the stock exchange in 11 years. So what does BlackRock actually do? Let's clear this up, because it is the source of most of the confusion. BlackRock is not a bank. It does not take deposits. It is not a hedge fund making wild bets with its own money. BlackRock is an asset manager. That means it invests other people's money on their behalf for a fee. Whose money? Teachers' pension funds, firefighters' retirement plans, insurance companies, sovereign wealth funds, and tens of millions of ordinary people through retirement accounts and index funds. The money in a BlackRock fund does not belong to BlackRock. It belongs to the clients. BlackRock's business is the fee, typically a small fraction of a percent per year. Sounds like nothing? Do the math. Just 0.1% of $14 trillion is $14 billion a year. That is the magic of the model. The fee can be almost invisible, as long as the pile is almost infinite. Charge a tiny slice of everything, and you get one of the most profitable machines in finance. The rocket fuel behind that 14 trillion was a revolution called index investing. For most of history, investing meant paying an expensive manager to pick winners. Index funds flipped the logic. Don't pick winners at all. Buy a tiny piece of everything, automatically, for almost nothing. It sounds boring. It quietly became the biggest shift in the history of markets, because for most people, boring won. Decade after decade, most stock pickers failed to beat the index they were trying to outsmart. And in 2009, BlackRock made the move that turned it into a giant. In the wreckage of the financial crisis, Barclays needed cash, and BlackRock bought its investment arm, including a then little-known ETF family called iShares. Today, iShares is the largest ETF platform on Earth, with over $4 trillion in assets and roughly a third of the entire global ETF market. When you buy an index fund, there is a very good chance you are, without thinking about it, a BlackRock customer. Then there is the part of BlackRock that almost nobody sees, Aladdin. The friendly name is actually an acronym: Asset, Liability, Debt, and Derivative Investment Network. Born from Fink's obsession with risk, Aladdin is a technology platform that models what could go wrong in a portfolio. Every bond, every stock, every scenario, thousands of simulated futures every night. And here is the remarkable part. BlackRock sells Aladdin to others. Rival asset managers, pension funds, insurers, even central banks run their risk through it. All in all, Aladdin watches over roughly $21 trillion. Even the competition runs on BlackRock's brain. That expertise made BlackRock the government's go-to fixer. In 2008, when the financial system was burning, the Federal Reserve hired BlackRock to analyze and manage the toxic assets nobody else could price. In the 2020 pandemic panic, the Fed turned to BlackRock again to run its emergency bond buying programs. Critics asked a fair question, and it is on the record, not a conspiracy. Should one private company sit this close to the state? When the referee keeps hiring the biggest player as an advisor, who is watching whom? Now, the question the internet loves: who owns BlackRock? The answer is beautifully circular. BlackRock is a public company, traded on the New York Stock Exchange. Larry Fink, the founder, owns well under 1%. Its biggest shareholders are other index fund giants, led by Vanguard. But Vanguard is owned by its own funds, which are owned by the people who invest in them. Follow the chain all the way down, and you land somewhere surprising. The ultimate owners of BlackRock are millions of ordinary savers. If you have a broad index fund in your retirement account, you quite possibly own a slice of BlackRock yourself. But that circle hides a serious question, and this one is real. BlackRock, Vanguard, and State Street, the so-called Big Three, together constitute the largest shareholder in roughly 88% of S&P 500 companies, and they cast about a quarter of the votes at those companies' shareholder meetings. Think about that. 3 firms, voting a quarter of corporate America. Legal scholars debate this seriously. What happens to competition when the same 3 shareholders sit on every side of every industry? And when BlackRock leaned into climate-focused voting, half the country accused it of pushing politics. When it eased off, the other half accused it of betrayal. That is what happens when you vote with other people's money. Every choice makes someone furious. Which brings us, as promised, to the conspiracy theories. Let's take the 3 biggest ones seriously for a moment, because each contains a lesson. Theory 1. BlackRock owns the world. You will see viral maps showing BlackRock as a top shareholder in Apple, Microsoft, Coca-Cola, everything. The maps are technically true, and the conclusion is false. BlackRock appears on those lists because it manages index funds on behalf of millions of people. The shares sit in its clients' funds. BlackRock cannot spend your pension on itself. Managing money is not the same as owning it. Whoever made that map confused a custodian with an emperor. Theory 2. BlackRock is buying up all the houses. This one exploded online, including a viral claim that BlackRock had quietly filed to buy $22 billion of family homes across 14 states. Fact-checkers traced it down. False. Much of it is simple name confusion with Blackstone, a completely different company. Ironically, the same one BlackRock was born inside 4 decades ago. BlackRock itself states it does not buy individual single-family homes. And by one 2025 analysis, all institutional investors combined own around 1% of America's single-family housing stock. Housing affordability is a real crisis. Its main causes are much more boring than a shadowy buyer with a black logo. Theory 3. BlackRock is the secret government of the world. Here is the thing. Almost everything BlackRock does is public. Its holdings are in regulatory filings. Its votes are published. Its government contracts made headlines. A secret world government that files quarterly paperwork with the SEC is, frankly, terrible at being secret. But strip away the cinema, and a real discomfort remains, and it deserves attention. Index investing has legally, openly, and voluntarily concentrated more shareholder voting power into 3 companies than has ever existed in financial history. No secret meetings were required. We did it ourselves, one sensible, boring retirement deposit at a time. The truth is less dramatic than the theories, and honestly, more interesting. So what is BlackRock in the end? Not a bank, not a puppet master. A fee machine sitting on top of the index revolution, wired into governments, watching the world's money through Aladdin, and voting a quarter of corporate America on behalf of people who mostly do not know they are being represented. Born from one man's $100 million mistake and built on a promise, know the risk. Maybe the final irony is this. The most powerful financial company on earth is owned, at the bottom of the chain, by the very people who are suspicious of it. So tell me honestly, does that concentration of power worry you? Yes or no, and why? The comments are open.